Okay, everyone. Well, thanks for joining us. We are recording this session just so everyone is aware. But good afternoon and greetings from the campus of Alma College. Welcome to the New Tax Law: Your Roadmap to Financial Success in 2018. My name is Matt Vandenberg, and I'm a 2002 graduate of Alma. And I serve as Vice President for Advancement, and I'm joined by fellow Alma Scott Doug Gross, whom I'll introduce in just a moment. We're delighted that you could join us this afternoon. This webinar is really the first installment of a new personal enrichment and professional development series that we're launching as a service for Alma alumni and friends. Because this is our first go at things, we may experience a bump or two along the way, but we should have a good time and be able to learn a lot. I'd be grateful to each of you if you could take mental notes on what you like and maybe what you don't like as much, and what recommendations you might have for us as we move forward. After this session, we'll send you a survey, and we'd be grateful for your input. We really want this service to be valuable to you and to others in the Alma community. As most of us are well aware, President Trump signed new tax legislation into law this past December. And speaking broadly, it made a lot of important changes to corporate and especially individual income taxes, including rates and deductions and exemptions. And if you're anything like me, your head kind of spins a bit just from thinking about all of the changes. And you're wondering, if you're like me, what it all means for you and your family. Maybe you're asking, what should I be doing differently because of the new law? Fortunately, we have lots of smart Alma College people with whom we can consult when we need this kind of advice. And so we turned to one of the best financial planning professionals we know, Mr. Doug Gross of Raymond James. Now, we asked Doug if he could help us address some of these pressing questions for us. Doug is a 1977 graduate of Alma College, and his wife, Sabrina Baker Gross, graduated in 1979. Doug and Sabrina have both been extremely involved with the college in recent years, with Sabrina heading our hugely successful student referral program, and Doug serving as a member of the Board of Trustees. Doug will take us through a short presentation that addresses kind of the big questions, and then we'll have lots of time for each of us to ask questions. But feel free to ask questions during the presentation as well. We really want this to be conversational. When you do have a question, just use your mouse to hover kind of toward the bottom of your screen, and you'll see a chat button. You just click on that chat button and type in your question and push enter. And then I'll relay questions to Doug. So with that said, I think we'll go ahead and get started. And Doug, thanks for joining us.
Matt, thanks very much for that kind introduction. I'm really pleased to have this opportunity to share some thoughts on the Tax Act with fellow alumni. So we'll get right into it here. Yeah, we'll be happy to answer questions, as you mentioned. So what are we really trying to accomplish here? Certainly financial success is driven by a lot of things. One of the most important things is saving. And saving money is just key to financial success, and the new tax law really helps that, in that many people will be paying less in taxes, and so will have the opportunity to save more money. But the tax law does have some little nuances that are going to have an impact, and people do need to understand, what are those nuances and how it will impact them. So we're going to go over that, and we're really going to help you to see what strategies you might personally want to consider that you then discuss with a CPA, attorney, or advisor to make sure that you most effectively take advantage of changes in the law. And one of our focuses here is going to be to really talk about your charitable giving strategy. And because of some changes in the law around itemized deductions and the standard deduction, for many people, they really need to think about a new gifting strategy, because what they've done in the past may not get them any tax benefit. And certainly we don't gift just to get a tax benefit. We give because we care about our church, about Alma College, about various institutions. But it is always nice to get some tax benefit in the process you're gifting. So, this law change was very complicated. Whenever people get their hands on the tax law for a major change, they can't resist in making a lot of changes. And that's certainly the case here. We're going to give you a really broad overview. There are a lot of little nuances that we can't, just for purpose of time, go into, where different exemptions, deductions phase out at certain levels. Well, exemptions actually are phased out entirely, but things don't apply to everybody. So we're going to be speaking in more broader terms, and certain things may or may not apply to you, particularly if you're in a very high income bracket. And then we're going to try to split it up into some different parts that might assess, what stage in life you're at, if you have children that are younger, children in college, and all that sort of thing. And then we'll also touch on, some of this language: deductions, exemptions, credits. We'll try to explain a little bit more about what they are, because, sort of like Matt said, for many of us that don't deal with this every day, it's kind of complicated. We'll seek to make it less complicated. So what's really happening here? Well, the biggest thing is that basically all the brackets move to lower levels, typically by 2 to 3%. So the 15% went to 12% as an example. So if you were formerly in the 15, you're now in the 12% bracket. So that makes a difference. And so that's probably the really major change that we should all think about. But then when they played around with everything else, that doesn't necessarily translate into lower taxes. The next piece is the standard deduction and personal exemption were combined. So many of you might at this point say, well, what does that really mean? And so I'm just going to bring over for a second. So this is the tax table this is, so page 1 of a 2016 return, but 2017 looks the same. And here you can see exemptions. And so in the past, you got an exemption for yourself, for married filing jointly, you got them for your dependents. And those exemptions made it so that a certain amount of your income was exempt from taxation. Well, they basically have gotten rid of the exemptions and combined the exemption and the standard deduction. Now, the standard deduction, what that does is here we've got itemized deduction table, and you get deductions for medical and dental, taxes, interest, etc. So what they've done is they've taken and said, well, the standard deduction is much larger, and unless your itemized deductions exceed the standard, there's really no reason to itemize. And that's going to be a big focus of our discussion. And so when they did this, what the real result is that probably we're going from about 30% of taxpayers itemizing to 10% or less. And so, what does that mean for most of us on a day-to-day basis? Well, a lot of the things that you may have kept track of in the past, you're going to realize I don't need to keep track of anymore, because I won't itemize. I won't have to go through and say, how much interest did I pay on my home? What were my business expenses? It won't matter anymore. However, of course, some of the things that you may have gotten a deduction for in the past, you won't anymore, like possibly your charitable giving, or possibly your other expenses, because they simply won't go beyond the standard deduction. And one of the key ones is mortgage interest. Is that for many of us, home ownership has resulted in us itemizing between personal property taxes on our home and interest on a mortgage that generally got most people beyond the standard deduction. But that's probably not going to be the case anymore. So it's certainly one consideration would be looking and saying, if I'm not getting any tax deduction for mortgage interest, should I pay off my loan? For many people, that's not really an option. That's a pretty big ticket item. But for people that are, getting up into their late 50s and early 60s, they've got their mortgage down to $50,000 to $100,000. They may have that much in liquidity and just go, I might as well pay it off because I'm getting no benefit. And then charitable giving is, for many people, if you don't itemize, you're not getting a deduction for your charitable giving. And so we're going to talk about strategies for that and how we can help you there. And then one of the important things is the income limits and a change in the income limit. And there's a child tax credit that has gone from $110,000 to $400,000. And so many people will get a child tax credit that didn't used to in the past. Capital gains are pretty much unchanged, so that's staying the same, really. So change in the tax rate, because they actually changed the different tables, they never could make this simple. To try to make it so that it's sort of comparable, we basically just took different taxable income levels and showed the tax that would be paid under the new tax law, and then we're showing the percentage change in the tax. So as an example, a single taxpayer at the $200,000 level is going to pay $45,000 in taxes. And this is just taking the taxable income. It's not considering deductions, exemptions, and all this. So if their income remained the same, their taxable income, they would pay 8% less in 2018. A joint filer at $200,000 would actually pay 15% less. And you can see that at the higher income levels, joint filers are getting some pretty good breaks. Now they're also losing things on the itemized deductions that you'll also see. But as you can see, depending on your situation, there's potentially fairly significant breaks in the taxes. So let's get into this itemized deductions a little bit more. And so why do we go from 30% of taxpayers itemizing to just 10%? So the typical things that we all itemized for in the past were healthcare if it exceeded 7.5% to 10% of your income, depending on your situation. State and local taxes, which would of course be property taxes, state income tax. And the state income tax is a really big one for high income earners, because if you're in a high tax state like California, you could be in as much as a 9% tax bracket. And so this is being capped, and that was an important deduction in the past that people are going to be limited on. Mortgage interest, of course, charitable giving, and then miscellaneous deductions. And miscellaneous deductions would be fees for tax preparation, fees to a financial advisor. There could be job-related miscellaneous deductions. All those we deducted in the past, and they're all gone. So all these itemized deductions essentially reduced your tax obligation. And if we go back to, Form 1040 here, what you see is that, at the bottom of the first page is your adjusted gross income, and that's basically all the things that were income factors. And on the second page, we had, your income, and then your itemized deductions. And so for many people, they did not take the standard deduction in the past, and they will now. And then that standard deduction reduces their income and gets towards that taxable income figure. So what's going to happen? That 10% of taxpayers will itemize. Well, healthcare must exceed 7.5% of income, which is not pretty comparable to in the past. But this capping of state and local tax deductions at $10,000 is really important. And you may have heard this term SALT being bandied around, which is basically state and local tax deduction. And so this limit is really significant because, when you take a look at your own return, you'll realize that for many, many people, they might have, paid $15,000 to $20,000 of state income tax, and then we had property taxes of $8,000 to $10,000, and we'll show some examples of that. So that's now being capped at $10,000, and it's really going to have an impact on who can itemize. Mortgage interest is pretty much unchanged, but new home equity loans taken for certain purposes for other than home improvements are not deductible. Charitable gifts are still deductible, but this elimination of miscellaneous deductions is certainly meaningful. So let's look at some examples here. So a taxpayer in 2017 that had property taxes and income taxes, a total of $15,000. Home mortgage interest of $8,000 and charitable giving of $5,000, miscellaneous deductions, tax preparation, financial services fees of $2,000. So they had a total of $30,000. In 2018, we've capped that at $10,000. So although they still had the same $15,000, they only get a deduction for $10,000. They get a deduction for the home mortgage interest of $8,000, and they still gave away $5,000 to charity. The miscellaneous deductions are eliminated. So if we add it up here, their total itemized goes to $23,000 from $30,000. So they've lost $7,000 in deductions, $5,000 from the state and local taxes, and the 2,000. So their standard deduction is 24,000. Effectively, all these expenses didn't make any difference. They just ended up with a standard deduction. So taxpayers in high tax states will really be impacted by this because they could have, very significant property taxes and very significant state taxes that they will no longer deduct because of this $10,000 cap. Now the SALT limit is the same for singles, so I think that's actually probably why you saw back here singles are not getting some of the same breaks in the tax table, is that single taxpayers do get $10,000 as the state and local tax deduction also. So let's take a look at some individual situations and how this would work. So if we took a family earning $180,000 per year, they've got a very nice income. They've got property taxes and state taxes of $9,750 and mortgage interest of $7,000. So in this case, they've got $17,000 of itemized deductions, of which $6,500 is disallowed under the new caps. So their total allowable is actually just $11,500. So in this case, they're a long ways really from taking the standard deduction of $24,000. And if they're doing charitable gifts, they'd have to give $12,500 or more to get a deduction. So I think this would be unfortunately, this is really what's driving this change from 30% of people itemizing to 10% or less. So we'll look at some examples of some of the child tax credit, which is another really important factor, and just the taxable income situation on some couples and a single individual with different income levels. So this first one, family of four, income is $75,000, and they've got a husband, wife, and 2 children. So their income's the same. In both cases, they have taken the standard deduction. Their income is relatively modest. And the standard deduction has gone from $12,000 to $24,000 for them, but the personal exemptions that they got in the past are now gone. So as a result of the Tax Act, by increasing the standard, they've gotten rid of the personal exemptions now. So their taxable income appears to be higher, going from $46,000 to $51,000, but their marginal tax rate has declined by 3% from 15 to 12. So the really good thing for this couple is that they are getting a child tax credit, and they got it in the past, and they would get it now. In the past, the child tax credit was only $1,000 per child, and now it's $2,000. So that really helps them very materially. Their total taxes dropping from $3,900 to $1,700.
Doug, this is Matt. Can I interject a question from someone?
Yep.
So does the SALT cap include state and local taxes paid by small businesses, like sales and franchise and payroll taxes?
So for a small business, they would be filing their own tax return, and they would not be, SALT would not apply to their situation.
Thank you.
Yeah, it's a good question. And so, it's fortunate for a business owner, they're able to run their business expenses through the business, and they're benefiting from the change in the tax law, and they're not impacted by this particular SALT provision. Okay. So now we'll look at this same family of four, and we'll assume that their income's gone up a bit, and they're at $125,000 of income. They're still not itemizing, they're taking the standard deduction. And once again, they've lost the personal exemptions. Now, one key thing is that the child tax credit used to phase out at income of $110,000. So at $110,000, you did not get the credit. So their tax and their marginal tax rate was 25%. You can see that their taxable income has gone up because of the loss of the personal exemption, even though they got a bigger standard deduction. But the child tax credit is really meaningful for them, with their taxes going from $15,000 to $10,000, well, really basically $11,000. But that's $4,500 savings in their taxes. Now, if we think of the same couple and their children have moved out of the house and are adults, in that case, they would have a very small, they have basically a $500 reduction in their taxes. So the child tax credit is pretty meaningful. So this example now is we're starting to ratchet up into really higher tax brackets. So this couple, income $175,000, their itemized deductions were $31,000 under the prior law, with the state and local tax credit. So one of the factors here that really is important is, what are you paying in state and local tax versus mortgage interest? So in this particular case, we're assuming that this couple had quite a bit of mortgage interest on their home, $15,000. And so their itemized deductions only went down by $1,100, which is really the $6,125 of state tax plus the 5, so they're only limited by a little over $1,000. And so they're still itemizing. Their taxable income is ending up quite a bit higher, but the lower tax rate and the child tax credit put them in a nice situation.
Excuse me, Doug.
Yep.
We had a great question come in. Can you let us know if the child tax credit caps out at a certain level?
Yes. So the child tax credit, where it caps out is that you can only deduct. Well, so in the past, the child tax credit could not result in you having zero taxes. So it could only bring your tax level down to zero. And the new law is that your child tax credit allows you to get up to a $1,500 refund. I'm sorry, it's either $1,500 or $1,400. But it is possible to get a refund. And there's some different figures in that depend on what your income is also. But it is now refundable. But if you had 10 children, just as an example, almost certainly you would not effectively get a $2,000 deduction for every child, because you'd have worked down to zero tax.
Thanks, Doug.
Yep. Okay, so in this couple's case, I guess as I look at this, because my daughters are basically out of the house, I think about it, okay, if I'm really a family of 2, I lose the child tax credit, you can see that my tax situation is not changing too much here. But that the mortgage interest was very helpful in getting me to itemize. So then this example is for a single individual in a very high tax situation. And you can see that they're, $450,000 of income. Their itemized deductions are ending up being capped. So they had $35,000 and now they're down to $30,000 because a lot of their state tax would just not be deductible. The standard deduction and the personal exemptions don't apply because they are taking itemized. They've exceeded the $10,000 SALT. So the taxable income is pretty comparable. Marginal tax rate in this case actually creeps up very slightly because the brackets changed a little bit, and their tax has gone up just a little bit. So I think that it's pretty rare. Actually, we had to look kind of hard to find a situation where somebody's tax went up. But you can see that for many cases, I mean, the reality is the tax law is designed to collect relatively similar amounts of money, but we are all in theory getting some breaks. And I think that many people will see a cut in their taxes of 5 to 10%, and this is kind of a rare exception. So now we wanted to talk a little bit about, alumni, they're in different situations. So families currently saving to fund college. So certainly one of the nice things is if you're paying less in taxes, you've got a little more money to be able to save for college. This child tax credit of $2,000 is really significant and adds up versus the $1,000 that was the child tax credit before. And the prior limitation of income of $110,000 is also, that's gone to $400,000, so it's much, much higher. But the tricky thing here is that the child must be under 16 or under at year end. I think I've actually typed that. So once they turn 17, they are no longer eligible for this credit. And then, the credit caps at a $1,400 refund. So the tricky thing is when your children are about to go to college, you're losing this deduction, and it goes down to just $500 while your children are in college. So it's going from $2,000 to $500. One other thing to consider certainly is that you're saving for college, and the use of 529 plans remains a very viable strategy. One part is in the state of Michigan, you get a deduction for the first $10,000 you put in the MESP, so that's helping you reduce your state taxes. And then 529 plans certainly have many benefits: tax-free growth in the plan, funds in a 529 can be transferred from child to child. If the first child doesn't use all the money for college, it can go to another child, or can even be passed on to the next generation. And certainly anyone can contribute to a 529. Could be your obviously the parents, grandparents, etc. So when your child is in college, what's your situation? Well, your child tax credit, as we mentioned, went from $2,000 to $500. So that actually kind of is a little dent in the budget, because the tax credit is very nice. And then the other things to consider: funds borrowed to pay for college. Interest is deductible to students, but home equity loans are no longer deductible. And one other consideration is certainly while your child's in college, you can certainly continue to contribute to their 529 plan. And I have many clients that do that. So now we're going to talk a little bit about gifting. And so we're transitioning a little bit from looking at people's tax situations to saying, okay, I get that. So now if I do want, obviously to continue to gift to the charities that are important to me, what do I need to do if I'm looking at the standard deduction and saying, gosh, I might not get past the standard deduction this year because of the change in this $24,000. So you just sort of have to imagine that if you're married, you've got to get over that hurdle of $24,000. If you're single, it's $12,000 is your standard deduction. So if we assume in this case you've got $14,000 of other itemized deductions, any gift of up to $10,000 results in you still using the standard and no real benefit from a tax purposes. So we're going to talk about 3 specific solutions to that. How can I get some benefit out of my gifting? And so the 3 we'd like to propose is bunching of gifts, using a donor advised funds, which is really another way to bunch gifts, and then gifts from your IRA, exclusively if you're over 70.5 based on the tax rules. So this first one, bunching charitable gifts, we're going to revisit slide 7, and here was slide 7. And in this case, as we saw, the individual in 2018 was giving $5,000, and yet they were actually still $1,000 short of being able to itemize. They had to give $6,000 to exceed the standard deduction. So any gifts of less than $6,000 were basically not deductible because they're taking the standard deduction. You could still fill out the form, but you just weren't getting anything from it. So what you could do alternatively is, let's just say you gifted $20,000, and you did that once every 3 years. The result is you could deduct $14,000 in the year you made the gift, because the $14,000 would exceed, adding the $14,000 to your other deductions, you'd be well in excess of the standard deduction of 24. So and then the other years you take the standard deduction. And so what does this really do? Well, you've saved $4,900 in taxes by making a single $20,000 gift every 3rd year. So that's, I think, a fairly significant savings and certainly worth doing. But the problem is, of course, you have to have $20,000, which is a very significant amount of money to be able to take advantage of this. While for many of us, I think that it's easier to give $1,000 here and $1,000 there than to come up with $20,000 every 3rd year. But this is one strategy. So the next strategy is using a donor advised fund. And these have become just incredibly popular in the last 2 or 3 years. They really are like having your own private foundation without filing a foundation tax return and doing all the things that are involved in having a foundation. Typically, people are gifting appreciated securities to fund these. Most donor advised funds have something between a $5,000 and $10,000 minimum as far as to put money in. And so you pay no capital gains on the appreciated position and get a tax deduction for the gift. So let's imagine that you were fortunate enough to buy Amazon a few years ago, and Amazon clearly has been a spectacular stock and has gone up a lot. And if you put $10,000 into Amazon, you could easily have $30,000 or $40,000 today. But you might not want to pay the taxes on those gains, but you might say, I wouldn't mind reducing the size of my position, because if the stock goes down, I've now got a lot of exposure to it. So what you could do is you could say, well, I'm going to gift $20,000 of my Amazon shares to my donor advised fund. I'm going to avoid paying any tax on the gains, and I get a deduction for the full $20,000. Then once you've put the shares into the donor advised fund sells the shares, reallocates to a model that you've designated. And then you can choose when you want to gift cash out of the account. So these are generally online. You go in, you say, send $5,000 to Alma College, and they write a check to Alma. So it's a very easy way to manage your gifting, and you would have got the deduction in the year you put the $20,000 in. So this always sort of, for people we first set these up for, there's kind of some confusion about, well, when do I get the deduction? It is important to keep in mind that you get it when you put money in, not when they send a check to the charity. Because everybody gets the letters from the charities and says, oh, you made a gift. And you just have to keep in mind that the gift was actually when you put the money in the donor advised fund. And they're pretty much available from all the major brokerage firms, Schwab, Merrill Lynch, Vanguard, Fidelity, Raymond James. So they're very easy to set up. So what are some really nice things you can do with a donor advised fund? Well, one is you can fulfill a pledge. You could pledge to give to your church, to Alma College, $2,000 every year, and you can set that up to where you just go online to your donor advised fund and say, please send them this amount every year. So it's really can make one of the things that I think is important is you sort of want to consistently give to the same charities that are important to you. And I think a donor advised fund is really an easy way to do that, because you just set it up and tell them, hey, make these gifts every year for me. And you just have to keep feeding the donor advised fund and putting more money into it, of course. It's great doing this whole bunching of deduction, but spreading out your gifts, just as we've talked about, is, I think for many of us, we might be happy to bunch the deduction, but the charities are kind of looking for us to send the money every year. So in this case, it's much easier to do that. One of the other key things is we have clients occasionally that have a really big income year. They had something happen where they just had a wonderful year, and they're looking for a way to drive down their taxes in that year. And a donor advised fund is a nice vehicle for that. One of the other things that many people want to do is while they're in their working career and they're in a high earnings mode, they'd like to give to a donor advised fund and fund that up to where when they retire, they've got a charitable account that they can use for many, many years. So there's some nice tax advantages to doing that while you're working. One of the other ones that we see is that oftentimes people have securities that, for whatever reason, they do not have cost basis, and this is getting kind of eliminated in recent years because systems are getting better. But you've got some shares that were given to you by your grandparent 20 years ago. You have no idea what their basis was, and so you gift those shares, and you never have to worry about figuring out, what do I owe? And then this last one is just systematizing your giving. Make that automatic gift every year to your charity.
And Doug, Matt again, just kind of a two-part question. The pledge fulfillment aspect of donor advised funds, first part of the question, is that new? And second part is, are there any hiccups that we might expect if we do have a donor advised fund and are intending to do that because you couldn't do that previously?
That's right, Matt. So that is new. And actually, I think that some of the donor advised funds there does seem to be a little hiccup in some cases where they'll say it can't be used to fulfill a pledge, but it certainly appears that in the reading of it that it is clear that they can be used for fulfilling a pledge. One of the things that I kind of experience is we just ask client not to say that it's fulfilling a pledge, that it's just a gift, and then it all goes through. So I don't know, it's sort of one of these goofy things where the law doesn't seem to be clear. If you just say that you're just sending money in, then rather than fulfilling the pledge, then it certainly works just fine.
But the manager does not want to be held sort of legally responsible for filling a pledge. Is that kind of the big?
I think that's exactly right.
Okay.
Good question. Yeah. Okay. But yes, that is a change. So so then this third strategy is one actually I was just talking to somebody about this morning is IRA distributions of over 70 and a half. So this really is kind of an ideal, one of the things that every taxpayer wants to do is have income that never shows up on their tax return, right? Or things that don't even come through their tax return. So if you're an IRA owner, once you're 59 and a half, of course, you can start to take money out of your IRA without any penalties, but you do owe taxes on that income. So many people in their, they retire in their 60s, they are starting to take money out of their IRAs. But once you turn 70 and a half, you're forced to take money out every year at a graduated rate. It starts at about 3.5% and then goes up. So if you have $100,000 in an IRA, you have to take $3,500 out in the first year that you turn 70 and a half. So what happens when you take that money out, of course, is you're taxed by the government because that was all pre-tax in that account prior to them. So the way around that, being taxed on the distributions, is to gift the funds directly to a charity from the IRA. And so rather than having the check go to you, it goes to Alma College, your church, and it never really enters your tax return. And it's not treated as income. Now, you need to give instructions to your financial firm to make the gifts directly from the account. And of course, it must be a gift to a charity. One of the other things that's important is if you actually do this strategy, most firms, what they actually report to the IRS is the amount that came out of the account, and they do not separate what went to you versus what went to charity. So it's really important as a taxpayer to keep track of that, because if you took $100,000 out of your IRA, it's obviously a wealthy individual, and you gave $20,000 of it to charity, you want to report as income on your return $80,000, not the $100,000 you took out. So that's just an important factor there. So, what's really happening here? Hopefully, most of us will pay less in taxes, and you'll have more money for saving, paying for college, charitable giving, and so that's a nice benefit for most of us as taxpayers. But as we've talked about, your charitable gifts may not be deductible. People that are really in kind of a good spot in a way, they pay a lot of mortgage interest, and also if you give a lot to charity. And in those cases, you certainly are deductible, but otherwise, you really need to have a strategy and really think about it. You don't want to end up in November starting to think about this and looking and saying, oh, I've given this money, and yet I got no benefit from it. So certainly think about using a donor advised fund, think about lumping of gifts, and then if you're over 70 and a half, the gifting directly from your IRA. So certainly, I think that, one of the things that my wife and I talk about is just that, really the goal is to do gifting and to have an impact on the charities that are important to us, and that's really the primary goal. But if we can get a deduction for it at the same time, that's certainly nice. So, Matt, I'll turn this over to you at this point.
Great. Thanks, Doug. This has been really helpful. A couple of questions are starting to trickle in. One question that I just saw is, can you keep any income earned in the donor advised fund?
Yes. So when you open a donor advised fund, you have a choice about how to have it invested. And so you can invest it, if your money's just flowing in and out, you might invest it very conservatively because you don't want to lose money. But if you actually have money in there for some period of time, you really don't want to miss out on possible returns of the market. So most donor advised funds have a number of investment choices, from a very conservative, maybe even a cash model, to an income model, to a balance, to a growth model. And so in each of those models, whatever returns are earned on the assets in the account are yours to distribute. And so that's one thing that we've seen is, for some clients, they've said, well, if I put $100,000 into a donor advised fund, and if I think that in the average year, maybe it'll return 5 to 7%, then maybe I could gift money out of this in perpetuity and just try to gift the gains. And none of that's taxable because you've already given the money away. It's not really your money, but you're able to manage it in that way, and it's very attractive. But certainly you do have to keep in mind that if you've done that and you found at some point you needed money back, you can't get it because you've given it away. It can only go to charity.
That's very helpful. Would encourage everyone to keep sending questions. I've got a couple in the meantime as we let folks mull things over. One question, and you touched on it a little bit, is what happens if I can't spend all of my 529 college savings plan funds on my own children? For example, maybe my kids got really nice scholarships, or maybe I didn't have as many college-going kids as I thought I would. What do I do in that situation?
Yes, so you've actually got a number of good options. One is certainly you can take the money back, and what you end up doing is you pay a 10% tax on the gains in the account, and it's actually a 10% penalty on the gains, and then income tax on it. So let's just say that you had $50,000 in the account left over, which would be pretty amazing, but you'd invested $25,000 in it over time. So your gains are $25,000. You'd have a 10% penalty of $2,500 and income taxes on the $25,000. So that's one option. You could also give it to your child, who would then be subject to the same tax, but it would be at their rates rather than yours. And then the third option that I think is really interesting is you could say, this could go for the next generation beyond my child. So it could go to a grandchild. And in that case, you'd really probably be looking and going, oh, well, this was in a 2020 fund. I need to change this to being a 2050 fund. This is a target date based on the date they might go to college. And then it could just roll forward and the money could sit there and grow tax-free until that grandchild went to college.
That really was an epiphany for me, and I imagined that it might be for others. So thank you very much for that. Again, please feel free to keep questions coming. Another one that came in is, if I don't have significant invested assets and I'm at the lower end of the income spectrum, is there any advice that I should be considering when I'm making philanthropic decisions?
Yeah, I think that in that situation, it's just based on the change in the tax law. The one thing that, but kind of in this case, what you've said is that you don't have a big investment account. Because if you're using the standard deduction, which many people in that situation would, really the only break you can get, and you're not 70 and a half and don't have an IRA, is if you give depreciated securities to the college, then you have avoided taxes on that, and so there's a tax saving there. But other than that, you're gifting, probably just truly as charitable. I think the most important thing is gifting to the things that are important to you. And I think the other part of it is that, a charitable gift that got you a deduction of 15%, well, now 12%, you're not really taking a big haircut. If you gave $100, it used to be that you got, a 12%, a $12 savings in taxes. So you could always just give $88 instead. So I think that sometimes people overthink this tax part of it. And if you're not getting a deduction and you're missing out on, a small tax benefit, I don't think that's quite as important as really continue to contribute to the things that are important to you.
Well, speaking as a representative of Alma College, who works with folks on philanthropic matters, I certainly appreciate that advice a great deal. Are there, I guess, a question that I'm seeing now, and I'm trying to make sure I get it right, are donor advised funds for everyone, or are there certain profiles of people for whom a donor advised fund makes the most sense?
Yeah, so I think that in terms of donor advised fund, it really starts with, do you have taxable assets that are starting to build up? So probably our typical client has that opens a donor advised fund has $100,000 or more in taxable assets, and they've started to accumulate, nice gains in the market after, we've had a pretty strong market for the last 10 years. And so they have positions that in many cases, we have people gifting shares and then buying the same shares back. So all they're doing is raising their tax basis in the shares. But I think a donor advised fund starts to become a logical thing when you have relatively significant taxable assets and you're gifting something like at least $5,000 a year to charity. So if you're giving less than that, it probably is not really worth setting up whatever your existing process of writing checks, may be perfectly adequate. But when you're starting to get to gift $5,000 to $10,000 and you have appreciated securities, then this can be a nice tool that can potentially simplify your life, avoid paying capital gains taxes, and kind of systematize your giving. So we've opened these for many, many clients, and it's actually very rare that somebody, once they get one open, doesn't go, this is a really nice tool. And usually you're with your advisor, hopefully you're sitting down late in the fall and saying, hey, are there any positions that have grown to be oversized, or we need to rebalance? And one way to rebalance my portfolio is to gift some shares. And so it's a nice tool for portfolio management.
I think one of my big takeaways from this presentation, Doug, is just that there are quite a few changes to the tax law. I wondered if you could comment a bit on how significant this tax change is relative to maybe some other adjustments that have been made over the years, and should we be expecting the unexpected moving forward?
That's a good question. I would say these are really meaningful changes. I think that for many people, this they did itemize, and so it was very meaningful to them. Mortgage interest, state and local tax interest. I think particularly people that live in California, New York, states where they pay high income taxes and high property taxes, this is going to have a real impact on their tax situation, and they really should take a hard look at it. And they may really, although the way it's being set up, what's withheld from your wages by your employer is actually being reduced by this change in the tax law, you could end up being pretty short in next April. And so I think it's worth having somebody run a pro forma for you if you're, particularly if you're in a high income situation, and make sure, hey, I don't want to end up owing a significant amount of taxes next year. So I think that this, it's a big change.
Thanks, Doug. Saw another question that came in, and that question is, could you comment on how a donor advised fund differs from a charitable remainder trust?
Sure. So a charitable remainder trust is really designed to give you a current income stream, and then at death, the charity gets the corpus. So you might have a significant asset. So typically people are setting up a charitable remainder trust at a much larger scale. So people are giving $500,000 into a charitable remainder trust that pays them an income every year, and then when they die, the remainder goes to charity. So with a donor advised fund, you never get income out of it. All you can get appreciation in the securities, but you're making a gift to charity. So they're really different designs. You're trying to accomplish two different goals. In the case of a charitable remainder trust, your typical goal is you have a you have a highly appreciated asset, which you do not want to pay taxes on, but you want to sell for whatever reason. And so you're selling it in the charitable remainder trust, so you're avoiding taxes on the gain, and then you're getting an income stream back from it. In the donor advised fund case, you just want to make the gift, and you're not concerned about an income stream coming back.
Great, Doug. Thank you. We'll pause for one more moment to see if any questions come in. I think we're starting to trickle down. Seeing none, I think we might move to wrap up. We're pretty close to our allotted time for the session anyway. So let me take this opportunity to thank everyone so much for joining us. We certainly hope you've enjoyed it and benefited from it. I know I have. As a reminder, you'll each receive a survey shortly. Doug, is it okay if we include your contact information on that survey in case anyone would like to reach out to you directly?
Yeah, that'd be fine. I'd be happy to, if they had other questions or can help in any way. Absolutely.
Okay, thanks, Doug. Appreciate that. Doug, thank you so much for sharing your expertise with us. Again, I really benefited from that a great deal.
Matt, this was a lot of fun to work with you and your team. And yeah, this was great.
We sure appreciate it. Thank you to everyone. And with that, we'll thank everyone again and sign off. Go Scots!